$42 billion in a single day. That sounds like a pretty insane bank run, right? No. Silicon Valley Bank might just be one of the most famous tech banks ever. But one thing always confused me: the speed of its collapse. I mean, how did a bank that was the darling of the startup world just vanish overnight? And why were so many companies caught completely off guard? So let's tackle that question. In this video, we're going to explore just how Silicon Valley Bank experienced the fastest bank run in modern history. So buckle in, it's going to be an interesting one. The numbers are just staggering. On a single Thursday, March 9th, 2023, customers and investors tried to pull $42 billion from Silicon Valley Bank. To put that into perspective, that's about $1 million a second. This was on a slow trickle of nervous depositors lining up outside a branch like you see in old movies. This was a digital torrent, a financial flash flood that overwhelmed the bank's systems and its ability to function. The sheer volume of withdrawal requests was completely unprecedented in the history of American banking. During the 2008 financial crisis, the run on Washington Mutual, which was the largest bank failure in U.S. history at the time, saw depositors pull $16.7 billion over a period of 10 days. SVB saw more than double that amount requested in just a few hours. The bank simply couldn't liquidate its assets fast enough to meet the demand. By the end of the business day, SVB had a negative cash balance of nearly $1 billion and was declared insolvent. This wasn't just a bank run, it was a bank sprint. And it set the stage for a weekend of pure panic across the entire tech industry. So before we go into the details, there are a couple of basic facts that we should be using in this video. SVB wasn't your typical neighborhood bank. For 40 years, it was the financial backbone of the startup ecosystem. It banked the innovators, the disruptors, and the venture capitalists who funded them. The numbers paint a clear picture of its deep integration into the tech world. Nearly half of all US venture-backed technology and life science companies banked with SVB. Think about that. A 1 in 2 chance that any given startup you heard about had its money in this one institution. The total deposit exposure was massive, with companies holding billions of dollars in their accounts. We're talking about companies like Roku, which had nearly $500 million, and Roblox, with over $150 million, sitting in SVB accounts. This concentration was a double-edged sword. It made SVB an expert in its niche, but it also created a single point of failure for an entire industry. When the panic started, it wasn't just a few isolated customers. It was a deeply interconnected network of founders, investors, and employees all reacting at once. The whole mess really began with what seemed like a smart move during a time of easy money. During the pandemic, the tech sector boomed. Startups were flush with cash from venture capital funding and soaring revenues. All of this money flowed into SVB, whose deposits tripled from $60 billion to over $189 billion in just a couple of years. The bank needed to put this mountain of cash to work, so it did what many banks do. It bought bonds, specifically long-term US Treasury bonds and mortgage-backed securities. At the time, these were considered ultra-safe investments. But there was a hidden danger. To fight rising inflation, the Federal Reserve started aggressively hiking interest rates, faster than at any point in the last 40 years. This created a death trap for SVB's bond portfolio. Here's how it works. When new bonds are issued at higher interest rates, the older bonds with lower rates become less valuable. No one wants to buy a 10-year bond paying 1.5% when they can get a new one paying 4%. As a result, the market value of SVB's massive bond portfolio plummeted. The bank was sitting on billions of dollars in unrealized losses. As long as they didn't have to sell the bonds, it was just a paper loss. But if they were forced to sell to cover depositor withdrawals, those paper losses would become very real and very catastrophic. This financial vulnerability set the stage, but the match that lit the fire was social media. The panic didn't start with a news report or a government announcement. It started in private WhatsApp groups and on Twitter threads. Venture capitalists, the gatekeepers of the startup world, began to sound the alarm. Influential investors like Peter Thiel's Founders Fund reportedly advised their portfolio companies to pull their money out of SVB immediately. This advice spread like a digital wildfire. Founders who saw these messages in their group chats immediately texted their own networks. Twitter threads popped up with step-by-step instructions on how to initiate a wire transfer out of SVB. The phrase bank run began trending. Unlike the bank runs of the past, there were no geographical limits. A founder in San Francisco could see a tweet messaged their co-founder in New York, who would then ping their finance team in London, all in a matter of seconds. The entire global startup community was connected in a real-time feedback loop of escalating panic. The bank's attempts to calm the nerves with a shareholder call only made things worse. The CEO's shaky assurances were live-tweeted and dissected, further fueling the fear. It was a meltdown in a hyper-connected age, where fear could be transmitted at the speed of light. The immediate consequence of this collapse was chaos, specifically payroll chaos. The ripple effect was swift and brutal. Within days of the collapse, a huge number of startups were facing an existential crisis. They had cash, but it was locked inside a failed bank. How do you pay your employees when you can't access your bank account? It's estimated that thousands of startups, representing hundreds of thousands of employees, were at immediate risk of not being able to make payroll. One survey revealed that over 10,000 companies, with more than 1 million employees in total, were facing this payroll cliff. The weekend following the bank's closure was a frantic scramble as founders and CFOs tried to secure emergency loans just to pay their people. The human cost was immense. Employees who lived paycheck to paycheck were suddenly facing the prospect of not getting paid, with rent and bills due. The entire startup ecosystem, built on dreams and innovation, was suddenly staring into a financial abyss. It was a stark reminder that even in the digital age, the physical flow of money is what keeps the lights on. And for a few terrifying days, that flow had stopped for a huge portion of the tech industry.